Kutzler YMX uses the Netrodyne two-way camera system in all of our power units. The Netrodyne cameras have more than once exonerated a driver who was perceived to be at fault, as well as saved our Kutzler YMX from paying damages related to an accident. We are already seeing, just in 1 year of Netrodyne, the impact of better safety scores and fewer damages and incidents in our insurance rates.
Welcome to this post-election Freightonomics. Zach Strickland, head of Freight Market Intelligence. Tony Mulvey, senior analyst. Here with you we're going to have on Dr. Zac Rogers, hopefully, if we can get connected there later in the show. If not, we will just continue to talk about what our hot takes are from the election outcome.
I think we finally have some, I don't want to say clarity. I mean, we have a little clarity. We know the results now, but it's what actually comes out of it is left to be seen, I guess.
Yeah, I think the biggest questions we get from a lot of the world is, what does this mean? What's what happens if this, if that? There's still a lot of uncertainty. I think this outcome may be the most uncertain of outcomes with the Republican win there. I think with Harris, if she had won, then we would have had a little bit more of a roadmap.
I'd say more the Republican sweep.
Yeah.
Right? Like that's the more.
Yeah.
There's no. I forgot who I was having a conversation with yesterday, but it was the checks and balances kind of way out now.
I think this was the outcome that I think you have a lot more decision making going on now with it, whereas before it was kind of like, well, we can kind of still sit back and continue to do what we're doing. Now I think a lot of companies and businesses are going to have to be very reactive. They're going to have to sit back and say, okay, because Trump has already shown us that he is very stimulus oriented. He likes to cut taxes, not necessarily spending, which is where the critics come in, but also the fact that he's very decisive and he moves very quickly.
Yes.
And that's unusual from the presidential chair a lot of times.
It's unusual from government in general, right? But I think it's something that we're going to talk about a lot, not just in this show, but throughout the next
several months.
Yeah, this is not going to be we have clarity on what's going to happen because things change. There's some of it, and what I've heard a lot from people I don't want to say close, but like people talking about this is, especially in his first term, when you look at it, it's maybe he said things that were more aggressive than what actually got implemented.
Yep.
But it's one of those, you almost have to expect the best, plan for the worst or worst case.
Well, he's very pro-business.
Yes.
And because he comes from business.
I think that's a good thing for freight.
It's very good for freight. I think we'll go through a list here in just a minute, but let's thank our sponsor, Tony.
Yeah. So remove the guesswork from driver management and fleet safety and start predicting your accident reduction cost savings. Netrodyne's AI-enabled video safety platform corrects unsafe driving habits, recognizing and reinforcing great driving. With the Green Zone score, your fleet of engaged drivers will protect your bottom line. Every 50 points earned is a 14% cut to your accident rate.
And of course, we're going to have one of the outcomes of this election is regulation. Yeah. There's actually a bit on tort reform that could be involved in reducing some nuclear verdict potential, but that has yet to be seen. We'll talk about that a little later. But let's do the market in two, and then get into it with Dr. Z.
Zach, if you're ready, I'll count you in 3, 2, 1.
All right, let's start things off. Outbound tender rejection index breaking 6% today for the first time since July. We are, I think, this is a little out of season for the tender rejection index to increase in early November. This is the first week of November, and we're seeing the second highest reading of the outbound tender rejection index. This is nothing to sneeze at. 6%, still not what we would consider a very tight environment. It's not like capacity is completely unavailable, but there's certainly areas of the country that are becoming increasingly challenged. And also the fact that this jumped up so quickly is it a sign for caution here. So let's move to the next item here, which is going to be the WRI map. If you look at this map, dark blue means tightening rapidly and significant tightening rapidly with the tender rejection rate. So this combines volume with the weekly change in tender rejection index. I'm looking at Ontario, the largest market in the United States. I'm looking at Joliet there, just the Chicago area, and I'm looking at Columbus, all huge distribution hubs for the United States. And you can almost trace a line of the natural flow of freight from imports going from Los Angeles up to Chicago and sometimes over to Columbus before it hits that corridor, the megalopolis, where all the population centers of the country are over there pretty aggressively. And if we go to the next chart here, we're going to look at Ontario in yellow and Joliet, which is the southern part of Chicago market, in white. Look at those rejection rates jumping here over the last week. Ontario has actually been managing quite well the tender rejections until they didn't. And now Joliet, of course, has already been trending higher through October. And of course, that's where all this freight lands. It's a lot of the rail. We've talked about intermodal really taking on a lot of this volume and bypassing that intra-mountain region. And the rails have been managing it, but then it jumps off the train and heads east.
Yeah, and once it does that, it's become more challenging. I think some of this is the capacity is being pulled to the West Coast, right? You kind of look at the timelines of how these rejection rates have moved between Joliet and Ontario. It's like a combination of carriers flooding the West Coast because they knew that's where a lot of freight demand was coming, even though Joliet's fairly large. But then when they move out west, it leaves the center of the country largely exposed to capacity disruptions.
Yeah, and this has not necessarily been a demand side event. It's not like we're seeing more volume. I have the OTVI here ready to kind of illustrate this. The OTVI, of course, the measure of total tenders, there's no spikes here. Yeah. Actually, tender volumes are going down. It's just that it's happening in an area it's creating imbalance.
Yes.
There's so much disproportionate volume coming off the West Coast versus East.
Yes, and I think that's the key takeaway is the imbalances that in capacity that have showed up. And I think this is what we've talked about before, that it's not going to be like this nationwide change or real. There's going to be pockets of the market that become exposed to disruption. And I think that's what you're seeing to some degree. I think some of it is you see on the West Coast specifically, you can see the ebbs and flows of capacity better because I think you talked about it this morning, but it's 4 days, basically 4 days out there and 4 days back, right?
From Chicago.
From Chicago. Yeah. So, I mean, you're talking, it takes time to get the capacity to get back out there.
And
there's not a lot of freight that moves back west. You maybe find some loads, but
much less.
Yeah, absolutely. So I think that's an interesting dynamic that's showing up in the freight market right now.
Let's talk about the one story I think that matters this week before we get into Dr. Rogers here. And of course, this is a wonderful article that everybody should check out at FreightWaves.com. Top 10 trucking policies likely to be affected by a Trump return. John Gallagher, John Kingston co-authored this one, both extremely well represented in their fields. I'm going to read through the top 10 here real quickly here. And I think I want you to pick out the ones you think matter the most. You've got engine emissions, speed limiters, autonomous, trade and tariffs, corporate taxes, tort reform, as we mentioned, truck parking, independent contractors, oil, and infrastructure. Which one of those really sticks out to you? I think there's a few here that stick out to me as headlines, but some of them actually matter more in terms of application.
I would say I think there's three that stand out to me. The first one being trade and tariffs, because I think that's a demand side component of it. The other one is going to be the engine emissions, the EVs. You haven't really seen a boost in Class 8 truck, EV, things like that.
That was an
like,
unrealistic.
It was an unrealistic
target
timeline,
to begin with.
and now it's just going to be pushed out further because the last one being oil.
Yeah.
I think they go hand in hand. I think you have a I would say easing of regulations around the oil and gas industry, which again kind of goes hand in hand with that EV, especially in the larger equipment types.
Yeah.
Like you're just, it's
the oil take was interesting to me.
Yeah.
They quote it, and John Kingston obviously has worked in that industry for a long time, but it's a little muddy on what that means for transportation. ExxonMobil CEO Darren Woods recently told CNBC that drilling activity at his company would not be impacted by who is in the White House. I'm not sure how drill baby drill translates into policy. However, what might cause oil prices to rise, and by extension, a rise in diesel costs for trucking, would be a new round of U.S. sanctions on Iran.
Yeah, that's true.
So it's almost like you would think that this would reduce oil costs, but it actually might be inflationary.
Yeah, I mean, you look at it in the past, though, when we boosted oil production. Now, what this is to say, oil production is still domestically is still near all-time highs.
Yeah.
Like October, I think there was a new all-time high in September, and then it slowed down in October slightly. I mean, it's so to that extent, but I think the oil market's an interesting one because the rate at which you drill is largely dependent on the price impacts. Like it's interesting that normally supply and demand impact price, and it's more supply gets manipulated because of what the price is doing versus like the actual underlying
just because
dynamics.
we produce our own doesn't mean that we control the market.
Correct. Largely we don't.
Yeah.
And I think what's interesting is, and I've had conversations about it, is like even at $50, $60 a barrel, like these oil companies still make considerable amount of money. Like it's not it. The other interesting part goes into corporate taxes. I mean, if you cut that, you're basically boosting their profit numbers at the bottom. So, I mean, I think of it from an oil and gas perspective. Like they're not incentivized to boost production if, it's going to cost them more every barrel that they produce. Like if it's going to cost more, there's no benefit to them doing that. But if you lower the cost overall in taxes, I think it does incentivize some because they know it's going to flow to their bottom line, which at the end of the day, what is their goal? Drive value for their shareholders or provide that back through.
Well, you're increasing the available amount of money, the money supply to an extent for people inside of the United States specifically. The ones that stand out to me, engine emissions, a reset of standards likely there. I think that's probably something that was never going to ultimately matter with the goals that they set. And I think speed limiters likely delayed. Large carriers like it because it reduces the amount of capacity available. Small carriers are opposed. That will get pushed off, which actually would be bearish in my opinion because that allows for capacity to cover more ground. And then the trade tariffs one, which is probably the one that I would say matters most for this show and this audience. I think this is a very bullish sign, at least on the surface, in the way that you're talking about domestic growth potentially. And of course, I want to get somebody who has lots of experience in supply chain and his opinion on this. Let's welcome Dr. Zac Rogers to the show. Dr. Z, welcome to November.
Hey guys, how's it going today?
No complaints here.
Yeah, we're doing well.
Are we ready for some tariffs?
Man, I guess I think that's got to be where we start, right? The tariffs. Like this is Trump's come out and said 60% tariffs blanket on everything. What are your thoughts here? What's your hot take?
Right. So it's 60% on everything from China, right? And then 10% everywhere else. That's the plan. That to me seems like a negotiating tactic. I can't see a realistic, there's business guys, behind him. I can't see us really doing 60% on everything. There's a Tesla factory in Shanghai. I don't know that 60% tariffs is really going to happen. If it did, that would be a true shock to the system. If you look at the freight market in 2019 when we had the recession, when the freight boom peaked, the sort of boom before that was April and May of 2018. The first tariffs on China come in I think June of 2018, and from June of 18 all the way down to February of 20, right before the pandemic sends another shock and we bounce back the other way. Freight prices were declining, capacity was going up because so much volume is soaked up by imports, especially imports coming in through the West Coast from China. And now that was a targeted raft of tariffs. That was like 25% on semiconductors, steel, aluminum, some machinery type appliances like washing machines, and then chemicals used for ag. That was kind of it, and that caused a big shock, not only for inbound but outbound. If you remember, China then put a ton of tariffs on us and stopped buying a lot of agricultural products. Soybeans and corn and on all this, pork and all these things. And so then we had to slow down, come back the other way. We had to bail the farmers out. And so, trade wars are tough. And I'm hopeful we don't go into one right now. I'm hopeful that it's a negotiating tactic, because the last time when we had very targeted tariffs, we had a slowdown. If we have a big one now, like just tariffs everywhere, okay, long term, we could see, all right, maybe things are going to shift over. And there's already, the difference between then and now is that we've been China plus one for now 4 or 5 years. We're on the other side of the pandemic where we've seen a lot of nearshoring, but we still don't have the capacity on the nearshoring side to make up for 60% on China. They're our third biggest trade partner. We had $500 billion of imports from China last year. Some back of the envelope math says if you put a 60% tariff on all of that, that's $300 billion in tariffs. Companies are not going to import as much, or they're going to pass the cost on to the consumer. Either way, that shrinks volume coming in, and I think really hurts, especially the freight lanes out of California. Now you could see some replacements, some Mexico and things, but again, I don't think this would be, I think, really inflationary. If I was, the reason I'm so hoping it doesn't happen is because inflation's really gotten out of control. The last, when we put out the LMI on Tuesday, what we said was, what a great economy. And I finished writing it on Monday, so I didn't know who the president was going to be yet. And I said, whoever inherits this is really inheriting a logistics industry that has swung back. I totally agree with our future Secretary of Transportation, Craig Fuller, that the freight recession is over and we're back into good times. And we look like, based on the way inventories are building up now and are projected to build up over the next year, like we'll be in a very solid market all the way through 2025. That could be disrupted if the tariffs hit hard enough. Now, the other side of that, and you guys talked about a little bit, rolling back some regulations, continuation of the tax cut. There are other factors that could sort of lift all the boats as well. And really where we're going to be is seeing those factors that we have already seen on Wall Street. We know there's going to be some positives. Are the tariffs going to be mild enough and I think targeted enough? That's a really important thing. Tariffs should be like a scalpel, not a hammer. Right. If they can be targeted enough, then maybe this could be an okay thing. But if it's really 60% on everything, that's going to be tough.
Yeah, I think it's, from my perspective, it's so interesting because it's like you touched on it where it can be inflationary, and I think he's come out and talked about like how he's wants low interest rates because I think it drives investment in business here in the U.S. Mm-hmm. But having inflation is you can't have both to some degree, right. And when you do have both, you get a situation like what we had in 2022 where you get what did inflation peak at, like 9 or 10%, close to it, and you had interest rates that were really low, and then you got to raise them really quick, and it just erodes demand rapidly. So I think that's interesting. So let's get into the LMI, because I there's some interesting takeaways when you look at it. I mean, it increased month over month. I think that sets the stage of this industry that's growing. Mm-hmm. But I think the interesting one was looking at inventories in aggregate, still continue to expand at a slower rate, but there was a changeover this month from upstream and downstream firms growing those inventories, where the downstream firms grew them faster or at a higher rate than what the upstream firms mm-hmm. did. And it's kind of different than what we've talked about the past few months, but I think it's exactly what you would expect with seasonality. That inventories flowing into retailers' supply chains. Is that the way to think about this?
Yes, yeah. So the overall index was 58.9, which is actually the best number for the index, I believe, since May of 2022, which we say the freight recession, according to our numbers, really started in June of 2022. So this is the best overall number we've had since the start of the freight recession. And you're absolutely right, Tony. Inventories are a big piece of this. Inventories were up to, and you've got it on the screen there, 59.4 in October, and a lot of that comes from, like you were just saying, downstream retailers. Retailers have really started to bulk up inventories for the holiday season, and really it looks like they actually peaked in the middle of the month, and now they're starting to come down, which is a really important distinction. But you're right. Before you get to the October split, downstream 65.7, great number. That's a robust rate of expansion for retailers. Okay, retailers are 65.7 downstream. Upstream, we're at 56.3, which is still expansion, but it's a slower rate of expansion. And actually, it's almost an inverse of what the numbers were in September, when upstream was in the 60s and downstream was in the 50s. And it's very different from the summer, when retailers were actually contracting inventories all the way through the summer and pushing inventories kind of upstream. I mean, basically what happened is we pulled forward a lot of imports all the way through the summer and the early fall, and then it kind of sat in warehouses in Riverside, California, in Phoenix and Las Vegas and Dallas. You know, one of the stories of warehousing and distribution this year has been the rise of the middle mile, where, okay, we're full in California, but we've got to pull all this inventory in because we can't be late on things. So we'll pull it in. We'll put it in Phoenix, put it in Dallas, put it in Austin, Kansas City, wherever we're putting it. And we sort of have these sort of regional inland, kind of port distribution centers that we're pulling things forward to, which has been fascinating. We saw that peak in the middle of October. One of the things we split every month in our results is early versus late in the month. And we saw a really interesting split this month, where inventory levels October 1st to the 15th, so the first half of the month, came in at 66.7. Inventory levels in the second half of the month, so the 16th to the 31st, came in at 54.1, which is still expansion, but not as fast a rate of expansion. And what that did was it drove up, so inventory costs in the first half of the month, 9 points higher, 71 to 61.9 in October. Warehousing prices were 8 points higher, 70 to 62. And transportation capacity was 8.5 points tighter. We actually had, for the first time, I think, in like 2 years, a half month where transportation capacity was negative. It came in at 45.8 in the first half of October. And then it relaxed a little bit to 54, which is still fairly tight. And actually, what I think it represents is more, it's just like we talked about last time I was on here, more capacity coming online as prices continue to go up. Now, you might hear those numbers and think, well, gosh, does that mean that this was a little bump and that it's not actually going to be a strong Q4? No, this is what's supposed to happen. This is what seasonality looks like. It just feels unfamiliar because it's been 5 years since it happened. We're supposed to peak in the middle of October and then have inventories run down a little bit. And we will see an increase in parcel, of course, as we go forward. And so that will spruce up some of the transportation prices. But essentially, if you look backwards at the last 5 years, you go 29 to 24, every year we bring in some inventory level in October, and then it comes down in December. I'll just quickly give it to you. So in 19, we go from a 55 in October to a 42 in December. In 20, we have a 68 in October. That was when things were absolutely crazy with COVID. Drop all the way down to all the way down to 56, which is still growth, in December. I'm going to skip forward to 22, and we're going to come back to 21 in a second. 22, we went from a 62 in October down to a 50-ish, 58 in December. And then, of course, in 23, our saddest peak season that we've ever had, our peak, it's really sad. Our peak inventories was only a little 53.4 in October 23. And that was all the way back down to 44 in December. The 1 year that didn't happen, the 1 year we didn't see the dip from October to December was 2021. Anybody remember 2021? We came in at about a 60 in October. Inventories were 61 in December. That was odd. We actually flagged that in the December report and said, hey, inventories aren't supposed to go up in December. What's going on? Well, by the time we got to February, those were at 80. And so all that stuff came in late, essentially.
Right.
And that's what killed us on inventories and basically heralded the beginning of the freight recession, was inventories not coming down in the back half of October and November and actually continuing to build and build and build until we got this just insane amount of inventory in the February of 22. And that came in right as, Russia, Ukraine, inflation goes crazy, and, the rest is history. And so the fact that we're at the 58, 59 now, and what we've dropped in October, that to me says we've got seasonality, we have regular activity. And if we look at things coming into the ports now, it's not like it's slowing down. Port of LA says, I think TEUs are going to be up 64% in the last week of November. Could be some pull ahead from tariffs, I don't know, but things are still coming in. And when we go forward 12 months, we see that we have a pretty strong expectation for the next 12 months in the LMI. The overall LMI a year ahead is at 65.7. That's a great number. 61.8 is the all-time average. And what's interesting is it's really being driven upstream. And I think this gets back to what you guys are talking about. Maybe some regulation changes. I think the other thing that's really, really happening is everyone was waiting for interest rates to come down. Now they are. If you can get a 5% loan instead of 8% loan, that sounds pretty good. And so I think a lot of our upstream and manufacturing has sort of been waiting. There's like a lot of potential energy that's going to turn into kinetic energy here. And their overall LMI prediction upstream 60 is 68.6, which is almost exactly one standard deviation above the average. The average all-time 61.8, right. And the standard deviation is about 8 points. So as long as you're between 53 and 69, we consider that to be sort of regular, sustainable growth. Upstream is going to be 68.6, downstream 61.2. That's like coming in at my temperature is 98.6 degrees. That's exactly where you should be. And so we'll have a lot of activity upstream, and it seems like that upstream activity is going to soak up a whole bunch of freight volume. And that's evident in upstream predicting transportation capacity to be at 43 over the next 12 months. That's contraction capacity. And guess what that leads to? An 82.3 in transportation prices. That's very strong levels of growth. And downstream, it's a 50, I believe, for capacity and a 78 for price growth. So that's really solid rates of growth. And like I said at the top of coming in here, this is about the healthiest and most normal that the supply chain has been in the 2020s. You can see in that graph there, those really high prices, that we had in 21 and 22. Those weren't sustainable. Having a 95 in transportation price growth, that's like driving 95 on the highway. It's fun, but if you keep doing it, eventually you're going to run into problems. It's not sustainable. These sort of levels now where we've had this sort of slow and steady recovery. Look at this chart is such a great one for you guys to put up because you can see how the recoveries have been. We go straight up and then straight down. And if you had the 18 and 19 in here as well, you'd see those were also straight up and straight down. And it's kind of the Isaac Newton, what goes up must come down. Well, now look at this recovery we have where those white and green lines cross in 24. This is like more tortoise in the hare. We're the hare now, or we're the tortoise now. Slow and steady. And according to these future predictions that has overall transportation prices coming up to 80 and capacity at 45, it looks like slow and steady is going to win the race. And when you add all the costs up together, we get a number that is not going to be highly inflationary for our total logistics costs. Could tariffs change that? Yes. But if we sort of stay the course where we are now, and this is my plea to the incoming administration, and again, I think future Secretary of Transportation, Craig Fuller, stay the course. Stay the course of what we're doing. We're seeing recovery in the logistics industry, and it looks like if we stay where we are, 25 is going to be a real bounce back year.
Well, you took us all the way to the end credits, and that was fantastic. You actually answered my question without even me asking it, because I was going to ask you about prices. But
hey, man, it's been 2 years. I know your deal. I know.
Like I could have just taken the day. Yeah.
Yeah. You know what? Next time, tell Isaiah to clear the runway, and I'll just go.
Hey, just put him on.